Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, recent Fed comments suggest some members from the FOMC, which is the Federal Open Market Committee, believe they should begin tapering their bond purchases this year. This is sooner than many had expected. So let's talk about tapering and what implications that has to our markets.
Yeah, let's start from the beginning, Steve. To provide much needed aid to the economy during the COVID crisis, the Fed slashed interest rates to zero and began buying treasuries and and mortgage-backed securities in the open market. And that provided the much needed liquidity to allow markets to operate during the crisis. So now, once the stimulus, the low rates and the asset purchases have stabilized the economy, normally you begin winding down those stimulative measures. And that can start by tapering your bond purchases. But this doesn't mean you just stop buying bonds. It means buying less.
Sure.
Because currently the Fed every month is buying, and these are big numbers, $80 billion a month in treasuries and $40 billion a month in mortgage-backed securities.
Those are big numbers, and it's hard for people to really probably wrap their arms around that.
Right. So they're continuing to stimulate an economy that has been repaired in many ways, and that can have consequences. So people worry about an economy that's overheating, perhaps, monetary or liquidity-driven bubbles in certain asset classes, or just runaway inflation seems to be top of mind for everyone and on the news a lot lately.
Yes, Travis, and if I'm thinking about this right, from an economic standpoint, tapering is a good thing. It signals the economy is improving, and there's no longer a need for that aid. Isn't that correct?
Yeah, that's correct, but there's some mixed messaging in the data, Steve. Inflation right now remains over 5%, although many believe that this is going to be transitory, that's the buzzword of the year, temporary, and eventually will settle in around that 2% level longer term. And we've talked about that in past videos.
Yeah, Travis, and the employment rate remains over 5%. That means that there are approximately 6 million fewer people employed than the pre-pandemic. Isn't that right?
Yeah, and then throw the emerging threat of the COVID Delta variant into the mix, and you can see why the picture really isn't that clear and remains hazy.
Yeah, and Travis, the Fed's job right now is really tough, and I don't envy Jerome Powell at all right now.
No, I don't think it's a job many people are after at the moment. But through all this uncertainty, Steve, the stimulus that we've talked about, has launched equity markets to all-time highs. I mean, think about this. The S&P 500 has gone over 10 months without even a 5% drawdown. So at this point, with markets at all-time highs and elevated valuations, they can be somewhat vulnerable to unexpected news like geopolitical shocks, which we seem to be seeing on a daily basis now, or unexpected or faster than expected tapering by the Fed that could cause a taper tantrum, as it's been called in the past.
We've heard that word in the past, haven't we?
Yeah.
This has been great, Travis. I look forward to it next week.
I look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.